Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, diversity to mitigate adversity, part 5 in our series on Understanding Asset Allocation. I don't want to put my eggs all in one basket. I just don't. I don't know what's going to be the winner. I don't have a crystal ball. The market doesn't give me a tip-off. The VIX report might tell me the sentiment that's out there for the S&P 500, but as far as any kind of indicator, sometimes even the option market might be an indicator, kind of tell me, but honestly, bottom line, we can't tell the future. We just can't. Nobody's invented a time machine yet. It's only in theory, or it's only in H.G. Wells' mind. So we got to come to a place of diversification to try to spread our risk to different asset classes so that we can have a pretty good shot at making money over the long haul. Remember, I keep saying long haul. If you're in the market for a 5-year quick run, you're the wrong place. Most people can't time the market, can't pick and choose when to buy and sell in such a short period of 60 months. Most people say, I need to do a long haul thinking, and retirement is that way. Long-term care, when you're thinking about your elder, to actually save for that, that's long-term. So you want to start thinking in those terms for retirement because you got the time. Now, I'm looking at diversification. Some people like mutual funds. Some people like EFTs. I kind of like EFTs when it comes to indexing for S&P and other indices for their foreign or domestic because they're really cheap. Now, they do have some exposure tax issues, and it could be an issue because remember, they're trading all day long, in and out, not like the mutual funds, which are settling up at the end of the day at the NAV, the net asset value. I like EFTs. They're a little cheaper, and they have, in my view, a little bit more option for a little bit more profitability without the exposure. But again, you're in the market, so it could become time where EFTs don't even have that kind of what I would call long-term thinking. But I want you to look at it because it's more inexpensive, and people are looking at EFTs now. Portfolios are moving that way because of cost and because of indices. Now, it's not always the play. People like individual stocks and bonds. That'll always be there. Mutual funds, you'll have to figure out what fund is working for you. But keep in mind, there's cost to all this. So when I'm diversifying, I'm doing it to limit my exposure. I'm doing it to spread out all my investments in different areas in case something bad goes down. I don't take it in one area. So I'm looking to limit my exposure. I don't want to put all my peas in the same pod. That is the problem that I'm always trying to defeat by using diversification to mitigate adversity. Diversity to mitigate adversity. So I'm looking at where I have areas, maybe in my management on my security or specific risks, credit, liquidity, debt levels, tax liabilities, litigation. These are little areas in companies that they may have, and I'm looking, hey, do they have exposure? Do they have holes in this? I'm trying to always limit my exposure. That's my goal. But I'm just an investor. I'm not running the company. I'm not running the fund. So I'm looking at companies that have good track records against some of these, what I would call places where the rat could get in. So finer distinctions and how much diversification? Well, you can really become quite diversified, not only in the subject that you're looking at, like let's say I'm a moderate to aggressive. I look at the mutual funds that have the lowest beta risk and moderate aggressive tendencies, and I want to see what the best return has been. I'm going to look at those, and I'm going to look at the expense loads on that, because that could come into play. Think about it. Some people, some boomers, are coming into retirement. They total their total expenses for the 401k administration. The plan participator had to pay. He's looking at all the costs of the expense loads, the RIA, his RIA, the Registered Investment Advisor fee. He's looking at the statement of additional information for the fund, which is not disclosed in the prospectus. That thing could be worth 100 to 144 basis points alone. They're looking at cash drag. Some of these mutual funds have to stay in cash positions because they have to be able to liquidate in case people want to terminate or surrender. They have cash positions. Those cash positions aren't making that much money, and many times it's a cash drag, maybe 75 to 80 basis points just because I'm in cash. So I want to look at the cost of my mutual fund, the cost of my ETF. If I'm in alternatives, I want to look at the cost for my REIT, my real estate investment trust. I want to look at the partnerships, if it's an LLC, LLP, LPP. I want to be able to look at this stuff and say, what are my costs for playing? If I'm going to use an annuity, most of the time on a fixed annuity on a rate like 3, 4, and 5, they've already paid the spread to the bank, the difference between what they're paying you as an investor in the annuity and what they have to make. They're going to make a spread on that. That's already been calculated. So if they say it's 3.4% for 5 years, that is the rate. The comp, everything, distribution costs, it's already been taken out. That's what you get. Now, if you're looking at costs on other annuities, be careful because variable annuities have costs. Is it worth the cost of accumulation? There could be other avenues for you to choose. I'm not really a fan right now. Used to be in the 90s and early 2000s, but everything changed now, and it's really not the great product that it used to be. So I'm a little soft on variable annuities. Now, index annuities, if you're buying an income rider, that costs you money every year. Some of them have embedded numbers that are a lot lower in the cost, but you need to look at that number. Remember, you're not getting dividends off it. You always want to look at what am I getting or not getting. So I can't participate in an index annuity with dividends, but it also has a hedge protection at the bottom end. So I have diversification. I have mutual funds. I have ETFs. I don't have any REITs anymore. I need to get more liquid, so I'm not buying real estate in those formats at this stage of my life heading into retirement. I also have fixed annuities because those rates are better than my bank rates. And I also have some cash left in the life insurance contracts that I have been using for different reasons and never had to worry about paying tax on it. And the last thing about diversification, by the way, too, I want to diversify on my tax structure. So some of my products will be qualified plans. That means they'll come out taxable. There is no basis. I can't recover basis. I got a tax deduction. And when it comes out, it's taxable, and it also flows over to the provisional income test of Social Security, and it's counted as income to find out if my Social Security benefits get taxed. So taxable, I'm diversifying. I have some in taxable. I have some in tax deferred. I just said I was in annuities. I have diversification in tax deferred. I'm not paying taxes today. I'm deferring them in the future. I'm not eliminating them. I'm not escaping them. I'm just putting it off. I'm deferring it. And the last category, tax-free or tax-exempt. Be heads up. They don't always mean the same thing. For example, you could have a municipal bond, and that could be tax exempt, let's say at the federal level or maybe even at the state level. But the actual income from the municipal bond flows over to your Social Security and is counted for the provisional income test. That could cause your Social Security to be taxed. Tax-free would be something like reverse mortgages from the home equity conversion mortgage under HUD. You could get tax-free from taking policy loans from cash value contracts that are TAMRA compliant, a regulation that your insurance professional can talk to you about. You could take money out of your Roth. That's totally, you never took a deduction. That money comes out. There's no RMDs. There's no, I have to take it out by 70.5 rule. So that's tax-free. And if you've been putting money in your HSA account, which is probably the smartest thing you ever could have done, that money comes out tax-free as long as it's used for Medicare premium, medical premium, disability premium, and you could even, for any legitimate medical costs, that comes out tax-free. Tax deductible, tax-free. I say load that up before you even talk about an IRA or anything else, except when your employer pays and gives you a matching contribution in your 401k. So I'm looking at finer distinctions when I'm talking about diversification. I'm trying to hedge my bet and to keep my tax bill low. Listen, I just talked to a client. He says, I have $1 million. And I said, well, actually, you don't. You have about $700,000. And he goes, no, I don't. I have $1 million. I said, well, when you take that money out, Uncle Sam's going to get his due. And right now in your bracket, as we move into your retirement, you're going to lose about 30%. Now, that included his taxation on Social Security. He was not really happy with that. And I'm sorry I couldn't do anything about it. I saw him too late in life to actually make a move from a tax point of view. If I'd have caught that guy in his mid-50s, I could start slowly moving money around to be tax aware or tax conscious so that when I start taking my money out, instead of having $700,000, I might have been able to keep $850,000. I can't do all tax free. I can't convert it all, but at least I could have done something. When I'm looking at diversification, I'm trying to look at my exposure to risk. I'm trying to look at how I can spread all my eggs in different baskets. I'm doing dollar cost averaging. I'm trying to do everything I can as a good investor to be disciplined, understand the environment that I'm in, and to move on into retirement, usually the biggest money that we need, into retirement, and have money for my lifestyle. I'm not having money for money's sake. My lifestyle is going to cost me something. Do I have enough to generate assets, to generate income to pay for my discretionary spending, as well as, of course, my obligations? I want to diversify so I can mitigate adversity. I want to thank you for watching our series on understanding asset allocation. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.